Have you ever found yourself scanning economic headlines, wondering what truly drives those subtle, sometimes quite dramatic shifts in global currency values?
Mm.
What if there was a fundamental principle, almost like a secret handshake, between interest rates and currency prices? Something that explains how money moves around the world, both today and well into the future.
It's a great question.
Well, today we're taking a deep dive into exactly that. One of the most foundational concepts in international finance,
Mm.
interest rate parity, or IRP.
Right, and our mission in this deep dive is really to pull back the curtain on this powerful theory. We'll trace its fascinating intellectual journey, demystify the different forms it takes,
Okay.
unravel the underlying math that makes it tick, and uncover its surprisingly practical real-world
Like
applications.
what kind of applications?
Well, think about protecting multinational corporations from unexpected currency swings, or even how astute traders spot fleeting profit opportunities. We'll even explore what happens when this fundamental principle seems to break down and what those cracks tell us about the global financial system. It's quite revealing.
So you'll walk away from this deep dive with a real shortcut to being well-informed, equipped with those satisfying aha
Mm.
moments, and a much clearer understanding of the invisible forces shaping currency exchange. And hopefully, without getting bogged down in too much jargon.
Exactly.
Okay, let's unpack this financial cornerstone. So let's kick things off with the absolute core. What exactly is interest rate parity?
At its heart, IRP is a powerful theory. It explains this interconnected dance between a country's interest rates, the current exchange rate, the spot rate as we call it,
Right.
and the exchange rate you can lock in for a future date, the forward rate. It's all about how capital instinctively flows globally, always seeking the highest return, but crucially adjusted for currency risk.
It sounds like a really fundamental idea. Does it have a long history?
Oh, absolutely. It's truly a cornerstone idea, and its conceptual roots stretch back centuries. You can find echoes of it in the writings of early economic thinkers like David Hume and David Ricardo.
Wow.
But it was John Maynard Keynes who, in his 1923 work, A Tract on Monetary Reform, really formalized it. He mathematically laid out how the forward premium or discount on a currency, basically, how much more or less expensive it is in the future, directly relates to the difference in interest rates between two countries.
And what's fascinating is that this wasn't just theory, right? It actually played out in the real world.
Yes, exactly. The explosion of offshore capital markets in the 1960s provided a real-world testing ground. And it turned out IRP largely held true, especially for major currencies, within the typical bounds of transaction costs.
Okay.
It really underlined that IRP isn't just an abstract idea. It reflects a deep, fundamental economic logic that drives global capital.
So it's more than just academic theory then. It's a pillar of how markets actually function.
Absolutely. IRP isn't just some obscure concept. It's a foundational pillar for understanding how currencies are valued and how foreign exchange markets actually work. Crucially, it acts as a kind of self-correcting mechanism.
How so?
Well, if there's a noticeable deviation, professional traders, arbitrageurs, they pounce on it almost instantly to exploit that temporary difference.
The arbitrageurs.
Exactly. This rapid action then pushes interest rate differentials and exchange rates back into alignment, helping to maintain balance in the global financial system. It keeps things sort of in check.
Which means IRP has incredibly practical applications for you, the listener, whether you're managing a business or just trying to understand the market.
Definitely. Think about multinational companies, for instance. They use IRP principles, specifically something called Covered Interest Rate Parity, which we'll get into,
Okay.
to lock in future exchange rates. This protects them against unexpected and adverse currency swings, essentially hedging away that risk. It's a core risk management tool.
And it goes beyond just hedging, you said. Traders use it too.
Oh, for sure. Savvy traders are constantly scanning for those subtle deviations from IRP to identify potential trading opportunities. It's like spotting a momentary imbalance.
Right.
Banks and major financial institutions also rely heavily on IRP for precise pricing of forward contracts and other complex FX derivatives. In fact, any significant persistent deviation from IRP can be a crucial signal.
A signal of what?
A signal of market inefficiency or mispricing, giving you valuable insight into what might be going on under the surface. It's like a check engine light for the currency markets.
Okay, now IRP isn't just one single thing, is it? You mentioned it comes in different flavors.
Exactly. It actually comes in two main flavors, and understanding their distinct characteristics is absolutely crucial to grasping how it plays out in the complex real world.
All right, what are they?
We have Covered Interest Rate Parity, or CRP, and Uncovered Interest Rate Parity, UIRP. Let's start with CRP.
Okay, covered.
This is what we call the hedged version. It explicitly involves using a forward contract. You use that contract to cover or hedge your exchange rate risk.
Like buying insurance on the future exchange rate.
Precisely. You effectively lock in your future exchange rate. This ensures that the return from investing abroad, once converted back to your home currency, is precisely equivalent to investing domestically. No currency surprises.
So if those returns weren't equal, that's where the arbitrage opportunity comes in.
Exactly. A theoretically risk-free profit opportunity would instantly appear, and those arbitrageurs, those financial bloodhounds, would descend on it, quickly closing that gap.
Makes sense.
That's why CIRP is considered so robust and is widely used for pricing and hedging. It works because you're eliminating the currency risk, making it a truly covered play.
Okay, so that's covered IRP. What about the other one? Uncovered.
Right. Uncovered interest parity, or UIRP. This is the unhedged version. It doesn't involve a forward contract.
So no insurance.
No insurance. Instead, it tries to connect the current interest rate differential to the expected future spot exchange rate. In essence, it's a forecast about what the market expects the spot rate to be at some point down the line.
But here's the surprising twist, and this is where it gets really interesting for me. Unlike CIRP, UIRP consistently falls flat in empirical tests, doesn't it?
It does. It's generally an unreliable predictor of future spot rates, and that's a huge insight.
Why? Why does it fail so often?
Because it relies on something unobservable, market expectations about those future spot rates. And those expectations are influenced by ever-changing risk premia, potential forecast errors, like what's known as a peso problem.
A peso problem, what's that?
Imagine markets holding their breath, anticipating a rare, massive event, say, a sudden, sharp currency devaluation, even if it hasn't actually happened yet. That expectation alone, that fear, can skew exchange rates today, making UIRP look broken in practice, even if the big event never materializes.
Fascinating. So UIRP is more about expectations, CRP is about locking things down.
That's a critical distinction, and it's important to remember that IRP isn't static. Central bank policy changes that impact interest rates, for instance, directly ripple through IRP calculations and expected currency movements.
Can you give an example?
Sure. Consider the appreciation of the US dollar back in 2022. That can be partly explained by IRP logic. As the Federal Reserve rapidly hiked interest rates, USD assets became more attractive relative to others.
Right. Higher returns.
Driving demand for dollars and pushing the exchange rate up.
Okay.
So IRP is a live analytical tool, constantly adjusting to market dynamics.
Okay, diving deeper into the mechanics then. It's crucial to understand that IRP, sometimes called the asset approach to exchange rates, isn't just pulled out of thin air. It's built on a few core beliefs about how global markets operate, right? Assumptions.
Yes, exactly. Think of these as the ideal conditions for IRP to hold perfectly, almost like the foundational rules of this financial game.
What are they?
First, there's investor behavior. The model assumes investors are rational, always looking to exploit differences in returns between equivalent assets in different countries. That drive then leads to adjustments in spot rates.
Makes sense. What else?
Then you need capital mobility, meaning money can easily flow across borders without restriction, and perfect asset substitutability, where domestic and foreign assets are essentially identical in terms of risk and liquidity.
Which might not always be true in reality, I guess.
That's a key point we'll come back to. The model also assumes financial account dominance, meaning capital flows, money moving for investment, have a much bigger influence on exchange rates than trade flows, like buying and selling goods.
Okay.
And underpinning it all is the no arbitrage condition. In a perfectly efficient market, there shouldn't be any risk-free profit opportunities just sitting there.
And are there indirect influences too, like inflation?
Yes, while not direct inputs into the core IRP formula, other economic forces like inflation, think the Fisher effect and the balance of payments, especially the financial account part, can indirectly shape IRP, particularly for UIRP, and influence the long-term sustainability of the rates it implies.
So why do these assumptions matter so much?
They're vital because if they're not perfectly met, say, a country has capital controls or transaction costs are high, or investors perceive different assets as having different risks, then IRP might not hold perfectly.
You see deviations.
Exactly. You'll see observable deviations, or what we often call a neutral band, where the deviation is just too small to make any profit after accounting for those real-world frictions. It's not worth the effort or cost to arbitrage.
Okay, let's get down to the brass tacks.
Yeah.
the core formulas themselves. Can you walk us through them?
Sure. For covered interest rate parity, that hedged version, the formula looks like this. S1 plus IT, 1 plus if T.
Okay, F equals S times that ratio of interest rates.
Right. And then for uncovered interest rate parity, connecting to expected future spot rates, it simplifies a bit too. E equals S, 1 plus I, 1 plus F.
Right.
Note, the T for time is often assumed to be 1 year here for simplicity, or you'd include it for compounding.
Got it. Can you quickly break down those variables again?
Sure. S is your spot rate, the current price of the foreign currency in domestic terms, like USD per EUR. F is the forward rate, that agreed future price, unique to CIEV. E is the expected future spot rate, that forecast used only for UIRP. A is the domestic interest rate, your local rate for period T. If is the foreign interest rate, the rate abroad for period T, and T is your time to maturity, usually in years or fractions like 0.25 for 3 months.
So if you strip away the math,
Yeah.
these formulas are basically ensuring an equal returns principle, right?
Precisely. It means the return you get from investing your money domestically should, in theory, be identical to the return you'd get from converting your money to a foreign currency, investing it abroad, and then converting it back.
Either using that locked-in forward contract for CIRP.
Or based on that expected spot rate for UIRP. That's the core logic.
Now, it's important to remember, you said IRP doesn't exist in a vacuum. It's part of a bigger picture, a web of economic theories.
That's a crucial point. It interacts with other major ideas. Take purchasing power parity, or PPP, for example.
How does that compare?
Well, PPP is an older theory. It focuses on long-term real exchange rates, driven by the prices of goods and inflation, the law of one price.
So like the price of a Big Mac everywhere.
Sort of, yeah, but for a whole basket of goods. The key difference is IRP focuses on financial arbitrage and nominal exchange rates over short to medium terms. PPP focuses on goods arbitrage and real exchange rates over the long term. Both are influenced by inflation and monetary policy, but through different channels and time horizons.
Okay, IRP for finance, PPP for goods prices. What about the International Fisher Effect, or IAFE? Where does that fit?
The IFE offers another piece of the puzzle. It suggests that nominal interest rate differences between countries should reflect their expected inflation differences.
And the link to IRP.
It's quite elegant, actually. If PPC and IFE both hold true big if there, then the interest rate differential should equal the expected change in exchange rates. And that's precisely what UIRP describes.
So the fact that UIRP consistently fails.
Exactly. It raises deeper questions about the assumptions behind IFE and whether currency markets truly have rational expectations. It's just maybe they don't, or at least not consistently.
Interesting. And then there's another model mentioned, the Behavioral Equilibrium Exchange Rate, or BEER. That sounds thirst-quenching.
Yes, beer.
Yeah.
It's a much more comprehensive model. It tries to explain real exchange rates based on a wider array of fundamental macroeconomic factors, things like a country's net foreign assets, its terms of trade, productivity differences, a whole host of things.
So it's broader than IRP.
Much broader. While beer models can include interest rates, their main focus is on explaining real exchange rates based on a larger economic story. IRP, by contrast, gives you that precise, almost instantaneous look at nominal spot-forward relationships through financial arbitrage.
So it's not about choosing one theory over the other. They work together.
Precisely. Think of it this way. IRP is your precision tool for short-term financial arbitrage. PPP is your long-term compass for fundamental value based on goods. IAFE tries to link interest rates to inflation expectations, and beer tries to paint the bigger picture for real rates.
So they offer complementary views.
Exactly. They're not competing truths. They're different lenses offering unique insights across different time horizons and through different economic mechanisms. An exchange rate can be perfectly in IRP equilibrium, meaning no covered arbitrage opportunity, but still be way off its fair value, according to PPP or beer.
Okay, so to really grasp the power and the limits of IRP, people don't just rely on theory. They test it with real data, right? Back testing.
That's where the rubber meets the road. Absolutely. Yeah. We get data from official sources like the European Central Bank, the U.S. Fed's FRB data, the IMF, and for real-time and historical market data, commercial providers like Bloomberg and Refinitiv, now LSEG, are essential. For the really granular stuff, high-frequency arbitrage studies, you might use specialized providers like tick data for tick-by-tick history.
What specific data points do you absolutely need for testing IRP?
You need precise FX spot rates, FX forward rates for common maturities 1 month, 3 months, 6, 12 months, and crucially, interbank interest rates.
And you mentioned a challenge there with interest rates changing.
Yes, a significant one for historical backtesting is the recent shift away from LIBOR, the old standard, to new alternative reference rates, ARRs, like SOF for the US dollar, STR for the euro, and so on.
Why is that a challenge?
Because LIBOR had a built-in credit risk component reflecting bank lending risk, which these newer ARRs generally don't have or have much less of. So comparing old LIBOR-based calculations to new AR-based ones isn't always apples to apples. It adds complexity.
So just getting the data isn't enough. Preparing it sounds like a job in itself.
Oh, it absolutely is. Data pre-processing is incredibly meticulous. First, synchronization. You have to align the timestamps for all data series, spot, forward, domestic interest, foreign interest perfectly, ideally to a common time zone like UTC.
Why is that so critical?
If you don't, you risk seeing misleading, spurious deviations that aren't real arbitrage opportunities at all, just artifacts of misaligned timing. Then there's data cleaning. Handling missing values, maybe through interpolation and dealing with outliers.
And those interest rates need careful handling too, right? Not just the LIBOR shift.
Definitely. Interest rate adjustments are subtle but critical. You have to account for tiny differences in how interest is calculated these day count conventions. Things like actual 360 for USD versus actual 365 for GBP.
Sounds like splitting hairs.
It might sound like it, but for high-value trades, even these tiny errors can dramatically throw off your IRP calculations and make a profitable trade look unprofitable, or vice versa. And critically, for realistic arbitrage analysis, you must use actual bid and ask prices, not just mid-prices.
To account for transaction costs.
Exactly. The spread matters. Once data is clean and synchronized, you apply the CIRP formula to get the theoretical forward rate. Then you simply subtract that from the actual market forward rate to get your deviation series.
When it comes to actually setting up a backtest, what are the key considerations?
Well, time frames matter. Are you looking intraday for high-frequency arbitrage or daily for broader trends? Sample size is crucial. You need a long historical period, ideally 20-plus years, to capture different market conditions. Normal, volatile, crisis.
And how do you measure success?
For pricing accuracy, maybe mean absolute error or RMSE. For potential trading strategies, you look at risk-adjusted returns like the Sharpe ratio, maximum drawdown, that's your biggest potential loss profit factor, win-loss ratio.
Yeah.
The usual suspects.
And you mentioned that arbitrage threshold or neutral band. That sounds pretty important for strategy.
It's absolutely key. A deviation from IRP only matters if it's big enough to overcome all your transaction costs. This band isn't fixed. It should ideally be dynamic, adjusting based on market conditions like volatility. Wider when costs are high, narrower when they're low.
And you have to be careful about backtesting traps.
Oh, yes. Pitfalls like survivorship bias, look-ahead bias, and overfitting your strategy to the past data are always risks. That's why rigorous out-of-sample testing and walk-forward optimization are so important to ensure your findings are truly reliable.
So you've done all that work, collected the data, cleaned it, set up the backtest, the moment of truth. What do the numbers actually tell us? How do you analyze those results?
Visualizing the story is usually the first step. You'd plot the actual market forward rate against the theoretical IRP rate over time. You see how closely they track, usually quite closely, but you also see where the gaps appear.
And then you look at the gap itself.
Exactly. You plot the CIRP deviation in the gap, often in basis points or pips. This chart often shows that neutral band around 0, where deviations are just noise, too small to trade profitably after costs.
Okay, so what are the big consistent findings when you look across markets and timeframes? Does IRP hold?
Broadly speaking, for CIRP, yes, it tends to hold on average for liquid major currency pairs during normal market conditions, especially once you factor in real transaction costs.
But the emphasis there is on normal.
Precisely. Because here's where it gets really interesting and, frankly, quite revealing. Backtests consistently show that during periods of intense market stress and financial crises, think the global financial crisis of 08-09, or the COVID-19 shock in 2020, deviations from CIRP become significantly larger and, crucially, more persistent. They blow out.
So why do these breakdowns happen? So it sounds like it's more than just small frictions.
Absolutely. It's due to fundamental issues deep within the financial system itself. First, increased counterparty risk. Banks suddenly become very wary of lending to each other. They don't trust that the other side can pay them back.
Makes sense in a crisis.
Second, funding liquidity shortages. It becomes incredibly difficult or prohibitively expensive to borrow specific currencies needed for the arbitrage trade. The plumbing gets clogged. And third, limits to arbitrage. Even if an opportunity exists, financial institutions face real constraints, capital requirements, balance sheet limits that physically prevent them from deploying enough capital to close the gap. It's not just a lack of willingness, it's sometimes a lack of ability. That really changed how people view CIRP, didn't it? It fundamentally did. We now understand it's not always a perfect, frictionless relationship. On the flip side, uncovered IRP, as we discussed, consistently fails empirically. It's just too unstable, too unreliable for forecasting, largely due to those unobservable, shifting risk premia.
So even if pure arbitrage is rare, the breakdowns of CIRP are incredibly valuable signals.
Incredibly valuable. They reliably flag increased market stress, liquidity problems, or big shifts in risk appetite. When you see CRP deviations widening significantly, it's like a financial seismograph detecting serious tremors underground.
So it becomes a diagnostic tool.
A powerful diagnostic tool for market conditions, yes. Even if it doesn't always point to a guaranteed profit, it tells you something important about the health of the system.
Let's bring this to life with a practical example. How would we calculate these deviations for, say, EURUSD?
Okay, let's walk through a simplified scenario. Imagine today, the spot EURUSDS is 1.0850. The Euro 3-month interest rate is, say, 3.75% per year. The US dollar 3-month interest rate, if, is 5.25% per year. Time T is 3 months, so 0.25 years.
Okay, got the numbers. If we plug those into the simplified CIRP formula, what theoretical forward rate would that give us?
Doing the math quickly. The theoretical would come out around 1.0810.
Okay, 1.0810 theoretically. Now, what if the actual market rate is different?
Right. Let's say the actual market forward factual trading right now is 1.0815. The CRP deviation is simply the difference. 1.0815 minus 1.0810, which is BRO0005 USD per EUR, or 5 pips.
So 5 pips. Is that a significant opportunity? Is that enough to jump on?
That's the million-dollar question. It really depends entirely on your total transaction costs. If your bid-ask spread on both spot and forward, plus any fees, adds up to, say, 2 pips.
So you have 3 pips left over.
Exactly. There might be a small opportunity there. But if your total costs are 6 pips, then that 5 pip deviation is actually a loss maker. It's not worth pursuing.
And it could be negative, too.
Sure. For USDJPY, maybe you calculate a deviation of -12 pips. That means the yen forward is cheaper than IRP suggests. And remember, it's absolutely crucial here to use equivalent interest rates, like interbank rates or term ARRs that reflect the actual borrowing and lending costs arbitrageurs face, not just generic central bank policy rates.
Makes sense. So how would you actually design a simple trading strategy based on these deviations?
Well, the basic signal is straightforward. You trade when the calculated deviation, actual minus theoretical, crosses some predetermined arbitrage threshold.
And that threshold isn't fixed.
Ideally not. It must dynamically account for all transaction costs, spot spread, forward spread, the interest rate borrowing lending spread, and it should probably expand during volatile periods when costs naturally go up.
Okay, so the signal triggers. What's the actual trade? How do you execute the arbitrage?
Let's say the market forward rate is too high compared to theory, like our 5 pip example. You'd effectively borrow the foreign currency, euros, convert it to domestic dollars at the spot rate, invest those dollars domestically for 3 months, and simultaneously sell euros forward at that high market rate of 1.0815 to lock in your profit.
And if the market rate was too low,
You'd do the exact opposite. Borrow domestic dollars, convert to foreign euros, invest the euros abroad, and simultaneously buy euros forward at the low market rate. Remember, this involves multiple transactions, each with costs. Institutions often use more efficient FX swaps to bundle these legs together.
and risk management is key, presumably.
Absolutely. You need clear entry and exit rules, stop losses if the deviation moves further against you unexpectedly, and take profits for when it reverts back towards zero. A pure IRP strategy is essentially a bet on the mean reversion of these deviations that they'll eventually snap back to fair value.
And what do simulated profit and loss results typically look like for such strategies? Is it a consistent moneymaker? A gold mine?
Hardly a gold mine. In liquid, efficient markets like major G10 pairs during normal times, profits tend to be quite modest, maybe even negligible after you factor in all the real-world transaction costs. Competition is fierce.
But what about less liquid markets or stressed periods?
Then the potential profits could indeed be higher because the deviations get larger. And it's a big, but so would the risks. You'd likely see much higher maximum drawdowns during those periods. The volatility of the profits, the drawdowns, that's a critical factor for any trader. It's not just about average profit.
Okay, so we've walked through the theory, testing even a potential strategy. But let's do a reality check. No economic model is perfect. Let's zero in on where IRP truly shines and, critically, where it falls short, especially when markets get turbulent.
That's essential for a balanced view. CIRP, the covered version, tends to work best or hold most tightly in highly liquid and efficient markets. Think major G10 currency pairs where information travels instantly and trading volumes are enormous.
And under what other conditions?
It also relies on relatively free capital movement across borders, very low transaction costs, and crucially, when the debt instruments used to derive the interest rates in both countries have genuinely similar credit and liquidity risks. Apples to apples, essentially.
So the sweet spot is?
The sweet spot is short-term maturities in G10 pairs under normal, calm market conditions. In that environment, CRP truly excels at accurately pricing forward contracts and FX swaps. It's the benchmark.
But you've hammered home that it's not perfect, especially during market stress. That seems to be the biggest asterisk.
It is by far the most important limitation. As we discussed, deviations from CIRP become significantly larger and much more persistent during financial crises, the GFC, COVID-19.
And the reasons, again, were those deep market disconnects.
Exactly. Increased counterparty risk banks just don't trust each other as much. Funding liquidity shortages, it becomes hard or super expensive to borrow certain currencies. And those limits to arbitrage banks hit their balance sheet constraints and simply can't deploy the capital needed to close the gaps even if they want to. These aren't minor frictions, they're fundamental.
What about other, maybe less dramatic limitations?
Well, everyday transaction costs always create that neutral band where small deviations aren't profitable. Capital controls or different regulatory barriers can definitely impede arbitrage and cause persistent deviations.
And the assets themselves might not be perfect substitutes.
Right, imperfect asset substitutability. If investors perceive differences in credit risk, liquidity, or even tax treatments between supposedly equivalent bonds or deposits, IRP can deviate. And of course, the big one. UIRP's empirical failure remains a major limitation for prediction, mostly due to those tricky time-varying risk premia and expectation errors.
And data issues can create phantom opportunities.
Yes, bad or non-synchronized data, or using incomparable interest rates, can make it look like there's an arbitrage opportunity when there really isn't one. Garbage in, garbage out.
So even when IRP deviates significantly, it's still a powerful tool. It sounds like the very failure of the model tells us something important.
It absolutely does. When CIRP deviates significantly and persistently, it provides crucial real-time information. Those large deviations reliably signal increased market stress, serious liquidity strains, or fundamental shifts in risk appetite. So, even if it doesn't always guarantee risk-free profits, IRP serves as an incredibly valuable diagnostic tool for understanding what's really going on under the hood of the global financial system.
Given all these insights, how can we refine and enhance IRP for even smarter decision-making? Can we make it more robust?
Well, for CIRP, a key enhancement involves making that neutral band or arbitrage threshold dynamic not fixed.
And how would you do that?
Instead of a fixed number of pips, you could estimate it based on historical transaction costs. Or maybe more sophisticatedly, use a statistical measure like a rolling standard deviation of past CIRP deviations, perhaps using models like Garcich that adapt to volatility.
So the threshold gets wider in volatile times and narrower in calm times.
Exactly. It reflects the changing reality of transaction costs and risks.
And for UIRP, even with its flaws, can you make it more useful? Not for prediction, maybe, but for understanding.
If you do try to use UIRP, the focus shifts from predicting to explaining why it deviates. You might attempt to explicitly model a time-varying risk premium.
How?
You could try correlating UIRP deviations with other broad risk factors, maybe the VIX index, credit spreads between bonds, various market liquidity indicators. The goal isn't to make UIRP a perfect predictor, but to understand the drivers of its often unpredictable behavior.
It sounds like the really smart play is to integrate IRP with other signals, not rely on it in isolation.
Precisely. The goal usually isn't pure, often fleeting, risk-free arbitrage anyway. Instead, IRP can be one powerful factor in a more multifaceted trading or analysis strategy.
Like combining it with what?
For instance, if a large IRP deviation appears, you could cross-reference it with order flow analysis. Is there heavy trading volume or a big imbalance in the order book for FX swaps or spot markets that supports this move? A deviation without supporting flow might be less reliable.
What about sentiment?
Market sentiment analysis, definitely. You can look at news, social media trends, investor surveys. In highly risk-averse periods, investors demand larger risk premia, which might explain wider IRP deviations. So strong negative sentiment might make you increase your arbitrage threshold or even step aside.
And for the really cutting-edge markets like crypto, there's even new data available.
Absolutely. For markets involving digital assets or stablecoins, on-chain data, things like stablecoin flows in and out of exchanges, large wallet movements can offer real-time insights into capital flows and currency demand that traditional indicators might miss entirely.
So if lots of USD stablecoins are flowing onto exchanges,
That could signal underlying USD demand, potentially impacting related FX swap bases and their IRP relationship. It's another potential piece of the puzzle.
but with all these integrations, there must be caveats, right? You can't just throw everything into the mix.
You're absolutely right to be cautious. Always be mindful of overfitting your model to past data, making it look good historically but fail in the future. Ensure any new signals are available in a timely manner. Signal latency is a real killer. And critically, confirm that observed correlations are truly meaningful and not just spurious coincidences. Data mining can lead you astray.
So the aim is a robust framework, not a magic bullet.
Exactly. Use IRP as a valuable signal within a broader, more robust decision-making framework, not as a standalone oracle.
Well, we've taken a really comprehensive deep dive into interest rate parity today,
Yeah.
a truly powerful and fundamental concept in international finance. You, the listener, hopefully now understand how it intimately links interest rates, spot rates, and forward rates. The crucial differences between that robust covered version, CRP, and its often failing uncovered counterpart, UIRP, and importantly, why deviations from this parity occur, especially during those critical times of market stress.
And while pure risk-free arbitrage opportunities might be rare, particularly in efficient major currency markets, IRP remains an absolutely indispensable tool. It's used every single day for precisely pricing financial instruments, for effectively hedging currency risk.
Right.
And critically, as that diagnostic indicator we talked about, when IRP breaks down, when those deviations get large and persistent, it tells us profound and important things about liquidity, about counterparty risk, and really about the underlying health and stress levels within the global financial system.
So what does this all mean for you listening? Well, the next time you hear about central banks raising or lowering interest rates, think beyond just inflation or growth forecasts. Consider how those decisions ripple through global markets. In the very fabric of how currencies are priced and traded, how those subtle or sometimes not so subtle differences in interest rates create both opportunity and risk across the globe. What will you look for in the news now, armed with this new perspective on IRP?
It's a great question to ponder. We hope this deep dive has given you a fresh perspective and perhaps sparked even more curiosity about the fascinating interconnected world of global finance.
We certainly encourage you to keep exploring